Good afternoon, everyone. My name is Dan Malor with Culzer & DePadova, and today what you need to know are the proposed regulations that were recently issued under Section 199A. My background is primarily in the taxation of small businesses, so 199A is, has been my life for the past year since the Tax Reform Act was passed in December of 2017. I also do estate planning administration and probate litigation. I practice in New Jersey, Pennsylvania, and New York. So for today's program, it covers a lot. I couldn't cover the entire set of proposed regulations, but I feel like I'm going to address the ones that are most pertinent, that are going to affect the most number of taxpayers. And I've divided that into about 7 topics here, which I'm going to move through pretty quickly. Hopefully this is not the first seminar that you've taken on Section 199A. There are going to be, I'm going to have some assumptions, or at least there's some background information that I may mention, but I'm not going to go through. I do have to rely on some basic familiarity with the provisions. I have some comprehensive examples in the beginning that hopefully will serve as a refresher. Again, it's not the first time that you've gone through an example of how to compute, just the basic computation of the deduction here. So if we can get started with some background. So the Tax Reform Act added new Section 199 Cap A to the Internal Revenue Code. 199A provides a deduction for non-corporate taxpayers. So so the deduction is available to individuals, and it's for qualified income, meaning income from a qualified trade or business. Qualified trades or businesses are pass-through entities, so sole proprietorship, S corporation, LLC, partnership, and so forth, and pretty much any business other than a C corporation. The deduction is equal to 20% of the income from that business, and if you are above a certain income tax or taxable income threshold, then there are other limitations that may apply. Limitations based on the wages paid by the business, property owned by the business, or the type of business that it is. There's an additional deduction for qualified REIT and PRP income. We'll talk about that later. And since this is a change to the individual portion of the code, it is set to sunset on December 31st, 2025. Recently, in Tax Reform 2.0 that just got through Ways and Means, they are looking to make permanent the individual tax cuts, and the 199A deduction is part of that package. Now the proposed regs, the first thing I'm getting to on the proposed regs is it clarifies that this deduction is only for income tax purposes. You do not get a QBI deduction towards your net earnings for self-employment or net investment income. And now the reason, why do we have this? Well, because if you look at the column here for under current law, so meaning law at the time that this was passed, 2017, the effective tax rate on pass-through entities was 39.6%, or I should say the top rate, because it was pass-through, only taxed at the individual level, and the top rate on individuals, once you include the Medicare surtax, was 39.6%. If you were a C Corp, you were paying double tax, so you had a 35% top corporate tax rate, in addition to a 23.8% capital gains or dividend rate. So your combined effective tax rate was 50.47%, so meaning there was roughly a 10% spread between operating as a pass-through and a C Corp. So if you go over to the right, under the Tax Cuts and Jobs Act, for C Corps, as we all know, they cut the corporate rate to 21%. So combined with that 23.8% dividend rate, the effective tax rate on C Corp earnings was reduced to 39.8%. So if nothing else were changed, it would essentially be the same rate on C Corp income as compared to pass-through income, and a lot of people had a problem with that. The whole reason people set up as pass-throughs was to avoid the double taxation, so the QBI deduction was the answer. So if you included a 20% deduction for qualified business income, so the top or far right column for pass-through entity, it reduces the effective tax rate to 29.6%. You're back to that 10% spread. So that's why we have the QBI deduction. So let's get into the computational rules and the changes that were made, and more so the clarifications that were made under the proposed regs to how to compute the deduction. So again, hopefully this is not the first time you've seen this. This is the statutory computation of the QBI deduction. It's equal to the sum of two numbers, the lesser of combined qualified business income or 20% of the excess of taxable income over net capital gain plus qualified cooperative dividends or taxable income less net capital gain. What I want to focus on is the taxable income part of it. All right, that's what the proposed regs address. And by the way, there's some really good examples in the proposed regulations. So if I don't provide an example, check out the regs. Chances are they have. So this first example is, we'll have a business, Mr. Robot, who owns and operates a computer repair shop as a sole proprietorship. The business generates $100,000 in 2018. Mr. Robot doesn't have any capital gains or losses. So after allowable deductions not relating to the business, so let's say a standard deduction, his taxable income is $81,000. Now QBI, because you're just looking at the income from the business, was $100,000. But when you calculate the deduction, you have to take the lesser of 20% of QBI, which was $100,000, so that the deduction could be $20,000, or 20% of total taxable income. His taxable income is only $81,000, so you're only going to get a deduction here of the $16,200. All right, so the idea here is that you're not getting a business deduction on top of all of your other deductions. It's a net number. You're getting on your net business income. So if you have a taxpayer where all their income is coming from their business, then their QBI deduction is not going to be 20% of their business income, right? You're going to have all those other deductions that apply first. You're only going to get your quote-unquote full QBI deduction if you have income from other sources. So now I want to look at kind of the second part of those clauses. So it's not just a taxable income limitation. There's also a net capital gain limitation. So if we just revise our example, so same facts as before, except now Mr. Robot earned $7,000 in capital gains in 2018. So how does that change the calculus? Well, now when you're looking at the taxable income limitation, you have to reduce that by net capital gains. So you take the $81,000 taxable income and reduce that by $7,000. So the actual number is $74,000. 20% of that is $14,800. And again, you take the lesser of those two numbers, so the deduction is going to be $14,800. All right, so those are the overall limitations, though. The sort of after you've computed the deduction, you had one more step. You still have to look at taxable income. So now we're going to pull back a little bit and just look at the QBI deduction itself. So the QBI deduction itself is the sum of two numbers. It's the sum of the lesser of combined qualified business income, or 20% of taxable income, plus the lesser of qualified cooperative dividends or taxable income plus less net capital gain. But we're just going to look at combined qualified business income, which is, again, the sum of two numbers. I'm not going to read through the whole thing. Again, we're going to spend more time on the top half. I just want to focus on the bottom portion of that now. Qualified REIT dividends and qualified PRP income. The proposed regs clarified what you do when you have a loss. So if you have a taxpayer whose publicly traded partnership loss exceeds their qualified REIT dividends, the loss isn't going to reduce your QBI deduction, right? Even though it's a sum, you don't count the loss in that sum. You're not going to have a negative adjustment. If you end up with a net loss, you just carry that forward to the next year and use it to reduce any REITs or PRP income in the following year. So if you end up with a net number at the bottom, you just ignore it. So we're just going to focus on the top portion of the computation here and look specifically now at what is qualified business income. So qualified business income, just back to the statutory definition, is, as I've said before, it's ordinary income from pass-through entities. It doesn't include wages, which means reasonable compensation and guaranteed payments. It doesn't include investment-type income, so capital gains, dividends, interest, or any deductions or losses that are allocable to those items. I'm going to focus now on capital gain and capital loss, because there was a question that arose when the statute came out. Well, what do we do with 1231 gain? 1231 or 1231 gain in law, it's a chameleon, right? 1231 assets are depreciable assets or real property used in a trade or business for more than a year. They're specifically excluded from the definition of capital asset. But if you sell a 1231 asset and realize realize a gain, it's treated as capital. Whereas if you recognize a loss, it's treated as ordinary. So it can change its character, and that character passes through and is retained to the individual owner. It's just considered Section 1231 gain or loss to them, which they then net. So how does this work in the context of QBI? So the proposed regs now provide that if your 1231 amount nets out to a capital gain, then your 1231 gains and losses are not QBI, right? Because QBI doesn't include capital gain. So if you've got 1231 capital gain, it's not QBI. If the 1231 amounts net out as an ordinary loss, then both the gains and the losses are QBI. And if the 1231 amounts net out as ordinary income, then both gains and losses are QBI, right? Because ordinary income constitutes a QBI. So I do have examples to clarify this. All right, so the first example, we're going to end up with a net 1231 gain. So Bob owns 50% of two S corporations, X Corp and Y Corp. In 2018, X Corp allocates $50,000 of 1231 gain to Bob. Y Corp allocates $30,000 of 1231 loss. So you've got a net gain of $20,000. So under 1231, that's going to be treated as capital, which means under 199A, you look at them individually. So now the $50,000 of gain from X Corp is not QBI, and the $30,000 of 1231 loss is also not QBI, right? Because it was a capital gain, treated as capital gain under 1231. Now we've got a net loss. So if we change this to where X Corp allocates $20,000 of 1231 gain, we've got a net $10,000 loss. So under the 1231 rules, that $10,000 loss is going to be treated as ordinary loss. So under 199A, both the gain from X Corp and the loss from Y Corp are considered QBI. So now that's pretty straightforward, I would think, till now. This last example is where it gets a little tricky. So if you have a net gain with unrecaptured losses, you have to do a proportional allocation. So again, same thing, two S corporations. Going back to example 1 where X Corp allocates $50,000 of gain, Y Corp allocates $30,000 of loss. But in this example, in 2017, Bob had $10,000 of unrecaptured 1231 losses. So the way 1231 works is if you have your $20,000 net gain here, which would normally be treated as capital, but because of the unrecaptured losses, you're going to treat half of that, $10,000 of the $20,000, is going to be treated as ordinary. So I made the example easy here because you've got $10,000 of ordinary gain, $10,000 of capital gain, which is half and half. So for 199A purposes, you're going to take each gain, so $25,000 for X Corp, 25 and 25, for Y Corp 15 and 15, and treat half as QBI and half as not QBI. I imagine in practice the numbers are not going to be so kind. So this is hopefully not too common, but for a lot of businesses that have 1231 gain, you're going to have to do this computation. 1231 gain is in the world of QBI, it's not a great thing because what you have with 1231 gain is because if you have a gain, not only is it excluded from QBI as capital gain, but it's also going to reduce the taxable income limitation. If you go back to the earlier slide, your taxable income was reduced by net capital gains. So if you have 1231 gain, it's going to reduce your taxable income limitation also. Now, at least if it's a loss, an ordinary loss, that is going to be used to adjust QBI downward. So for QBI purposes, 1231 is really the worst of all possible worlds. There are also questions about NOLs. Do they impact QBI in a current year? And the proposed regulations provided that carry-forward NOLs do not impact QBI except for one new exception, which makes sense if you had a large loss in a prior year. You've already reduced your QBI down to 0, more than likely. So they're not going to. Well, it's actually taxpayer friendly because just because it went down to 0, there was still additional loss. If you had made more income, that loss would have been used to reduce your QBI. It's actually a favorable provision that you don't have to then carry that loss forward and reduce QBI in subsequent years. So I guess the lesson as tax planners is if you're going to generate an NOL, you amp it up. The larger your NOL, if you can accelerate deductions and increase your NOL in 1 year, you're indifferent for a lot of other provisions, but for QBI, you're in better shape, right? You want that larger NOL rather than taking a loss in a subsequent year when it might be used, when you might have positive QBI. So the one small exception that this is subject to is there's a new loss. It's I think termed the active business loss under Section 461L, and this is where a taxpayer can't have a net business loss of more than $500,000, basically. So if you have a disallowed loss, meaning a loss that was not permitted because of this new Section 461L, that does reduce QBI in a subsequent year. I don't know conceptually why that is. Maybe it's just because they came in together. They're going to be used together, but that's the one type of NOL that would impact QBI. All right, so before we go any further, I want to run through, like I said, a comprehensive example. I may have lost some of you already. So hopefully this is, again, not the first time, but I want to do one comprehensive example to show, just to clarify how all of the limitations operate together. So in this example, we have Chen LLC. It was taxed as a partnership. Nathan and Karen each own 50%. Nathan's allocated 80% of the depreciation and 30% of all other items. The LLC paid W-2 wages of $300,000 and reported ordinary income of $1 million. The sole business asset of the LLC is a rental property that was purchased for $1.2 million, has an adjusted basis of $500,000, and a fair market value of $1.5 million. So this structure, if you've ever taken a seminar with me, this is very familiar. I think some other advisors use this as well. But I'm going to now go through this step by step. This is how, for most taxpayers who are subject to the limitation, this is how you're going to have to calculate their deduction. So like I said, I'm going to go through it step by step, starting with what's 20% of QBI, right? That's our mark that we're shooting for. So what you need to know to calculate 20% of QBI for a partnership is what is the income of the partnership and what percent interest, what income interest does the partner have. So in this case, Nathan had, the LLC had income of $1 million, and Nathan had a 30% interest in other partnership items, including income. So for the first part of the computation, you just take $1 million times 30,000 gets you to $300,000. So 20% of that is $60,000. All right, that's with no limitations. Other limitations would be his QBI deduction. But you now have to look at the second part, the wage and the basis limitations. So to determine your wage limitation, you need to know what wages the partnership paid, and again, how much of that was allocated to the individual partner. So in this case, 30% was allocated of $300,000 of W-2 wages. So again, you plug in those numbers. 30% of $300,000 is $90,000, and then half of that is $45,000. You don't stop there. If the partnership owns property, you need to check whether the basis of the property combined with the wages is going to give you a better number, because you get to take the greater of those two. So to determine the wage plus basis portion, in addition to knowing the allocation for the wage deduction, you need to know how depreciation is allocated. Partnerships can have all different types of special allocations, and depreciation is one that may not follow with your partnership interest or match the wage deduction allocation. So in this case, Nathan gets 80% of the depreciation, and that's what you look to determine how much of the basis in the property is allocated to Nathan. So the basis we care about is the unadjusted basis immediately after acquisition. We're going to talk more about that later. So in the case of a purchase, it's your cost basis. So this LLC purchased their property for $1.2 million. That's the unadjusted basis for 199A, and Nathan is going to get to use 80% of that. So unadjusted basis of $1.2 million times 80% times 2.5% is $24,000. So you add that to 25% of the W-2 wages, which was $22,500, to get to $46,500. All right, now we're going to do a bunch of comparisons, right? So first you look at the bottom half, and you get to take the greater of the two, either the wage limitation or the wage plus basis limitation. In this case, the basis limitation gave us the better number, $46,500, and then you compare that to the original 20% of QBI number, $60,000, and take the lesser of those. So that means that in this example, the QBI deduction would be $46,500. So hopefully, again, hopefully that was a refresher. But before we get into more detailed discussion of the wage plus wage and basis limitations, I wanted to at least go through one. So that that whole computation was done when you had a positive number. What if you have multiple businesses and some of those businesses end up with a loss? What do you do with businesses that have negative QBI? Well, if you just have a net loss, it's easy. All right, a net loss, this was under the original statute, told us that you carry forward a net loss to the following year, and it's treated as a loss from a separate trader business. All right, so if you had three businesses that produced a loss, you had business A, B, and C. A had $100,000 of income, so did B, but C had a $300,000 loss. You're going to have a net $100,000 loss. You don't have to allocate that in the following year to C. You treat it as essentially a business D with a $100,000 loss in the following year, and then you net them again to see what happens. So just quick example, you have Alice who is allocated $300,000 from LLC 1 and a $400,000 loss from LLC 2. I've included what her W-2 wages are and her taxable income, but it really doesn't matter. A net loss, there's no limitation applied. You just carry it forward to the following year. The question after the statute, which the proposed regs have now answered, is what if you have multiple businesses and they generate a net QBI gain, net income, but one business had a loss. One big business had negative loss. How do you deal with that, right? Because how do the wage limitations apply and so on. So the proposed regs provide that you allocate the loss from one business among the income businesses in proportion to their respective QBI amounts. Once you've done this allocation, then you apply the wage and basis limitations without taking into account any of the W-2 or basis amounts attributable to the lost business. So we're going to expand the previous example. So when there's two businesses, it's still pretty straightforward. Now we've just I'm sorry, I should have switched these. In a two-business example, we don't have to worry about allocation, right? Because we're going to end up with a net income of $100,000 and apply the wage and basis limitation. We got wages in LLC 1. So 20% of the net QBI in this example was $20,000, and we had $100,000 of wages paid by LLC 1. We get to use 50% of that. So the lesser of those two numbers is $20,000. If, on the other hand, the W-2 wages were paid by LLC 2, we wouldn't be able to take those into account. Right? You're not allowed to use any of the amounts that are in the loss business. So we only get to use it here because the wages were paid by LLC 1. If we have a 3-business example, before you apply any of the limitations, you have to figure out what to do with how to allocate the loss. So in this case, LLC 1 has $100,000 of QBI and pays $50,000 of wages. LLC 2 has $100,000 of income but pays no wages. And then LLC 3 has a $100,000 loss but pays $70,000 in W-2 wages. Now her taxable income, by the way, does matter because we're applying the wage limitation. So the first thing you have to do is allocate the loss proportionately. Again, I made the numbers easy. LLC 1 and LLC 2, the gain businesses, earn the same amount of income, so you just take the loss and allocate it half and half. So you're going to split the $100,000 loss 50-50 between LLC 1 and LLC 2, reducing their QBI to $50,000. Next step is you compute their deduction while applying the wage and basis limits. So for LLC 1, the net QBI now is $50,000. 20% of that is $10,000. And it paid $50,000 in wages, so 50% of that is $25,000. So LLC 1 is going to get a QBI deduction of $10,000. But for LLC 2, again, 20% of $50,000 is $10,000, but LLC 2 didn't pay any wages. So 50% of that is obviously 0, and the lesser of those two numbers is what you get. So LLC 2 is not going to get any deduction in this case because it didn't pay wages. This taxpayer, Alice, would be a prime candidate for aggregation. We're going to talk about aggregation in the next section. Okay, so we're going to get now we're going to talk about the individual components of the wage and basis limitations because the proposed regs gave us a lot more clarity on that. So okay, so when I say wage and basis limitations, I'm talking about the second half of the computation. The 50% of W-2 wages, I tend to call that the wage limitation. And then the 25% of wages plus 2.5% of unadjusted basis, I call that the wage plus basis limitation. Both of these limitations are subject to a safe harbor. So under the original statute, 199A B3A, if the taxpayer's taxable income is less than the threshold amount, you can ignore the wage and the wage and basis limitations, and you can also ignore the specified service trade or business limitation, which I'm going to talk about in a few minutes. For 2018, the threshold amounts were $315,000 for married filing jointly, and $157,500 for all other taxpayers. And those numbers amounts are indexed for inflation. You obviously compute taxable income without taking QBI deduction into consideration. They're not going to let you take the deduction to determine whether you can take the deduction in the first place. And the safe harbor is phased out above the threshold amount. So it's not a cliff. It's not as though once you make $315,001, you no longer get your deduction, or you have a phase-out range of $100,000 if you're married. And for the most part, I'm going to be using married taxpayers in my examples unless I say otherwise. So the phase-out range for 2018 is between $315,000 and $415,000. So I'm going to go through, again, just another example to show you how the phase-out works because I'm going to be using it going forward. So this is the phase-out of a taxpayer who has both wages and basis limitations he needs to worry about. So we have Mark, who's a property manager, operated as sole proprietorship, and he pays W-2 wages of $100,000. The unadjusted basis of the property is $200,000. The business earns $300,000 in 2018. Mark is married and reports taxable income of $390,000 on his 1040. So the first thing you do is you have to figure out what the excess amount is. The excess amount is how much better off would you be if the limitations didn't apply. So the first thing you do is just compute your 20% of QBI. Right? That would be your deduction if the limitations didn't apply. So in this case, the QBI was $300,000. 20% is $60,000. Then you have to compare. Then you have to look at, well, if the limitations did apply, what would my QBI be, deduction be? So I'm going to kind of start from the bottom and work my way up. So if you look at the wage limitation, it paid the business paid $100,000 of wages. 50% of that is $50,000. It also owned property, so we need to check that. But since the property was only worth $200,000, you're only going to generate $5,000 of basis. When you add that to 25% of the wages, you get $30,000. Between those two, the greater is obviously $50,000. So we get to use that. Then again, and that $50,000 would limit the QBI deduction because you get the lesser of those two. So your excess amount, meaning the amount that you would benefit if the limitations didn't apply, is $10,000. Right? With the limitations, you only got 50. Without them, it'd be 60. So then you take your excess amount, and now you determine your phase-out percentage. Phase-out percentage just means how far into the phase-out range are you. So I made the numbers easy here. Mark earns $300, his taxable income. He's filing jointly. The taxable income is $390,000, which is $75,000 above the threshold. So he's used up 75% of his phase-out range. So then you're going to take the phase-out percentage and multiply it by the excess amount, and that's going to get you what I've called your QBI deduction reduction. I call it that because it rhymes, and maybe you'll remember it. So 75% of $10,000 is $7,500. You take your original QBI, or the QBI deduction without the limitation. So if we go back, that was $60,000. You reduce that by the QBI deduction reduction, and you get to $52,500, and that is your phased-out QBI deduction. All right, so again, this was all under the original statute. I just wanted to go through it one time before we get into the individual components, because I'm going to use phase-out language now just in passing. Okay. If you have a taxpayer who is not only subject to the wage and basis limitations and in the phase-out range, but it's also a specified service trade or business, you have to do an additional phase-out. So there's a three-step process. First, I want you to go to the proposed reg 199A-1D4. Example 4 is a great, really lays out well the steps to going through a double phase-out. Then I want you to go have a drink, have a big drink, and then we can all pray together that the software will be able to handle it. Even if you understand it, and I do, it's not that complicated. It's just before you do the wage and basis limit phase out, you figure out the applicable percentage again, and then just multiply all of the items of QBI by that number. So you reduce sort of the whole pot by the percentage, and then you apply the wage and basis limitations to see if that gives you a lower number. It's just very tedious, and to have to do that for all of your clients, it's going to drive up the cost of preparing a return. So hopefully the software will just be able to do it. Ultimately, it's just arithmetic. Okay, so we got more clarity on what exactly W-2 wages are in the proposed regs. So under the statute, we know total wages are defined as wages subject to wage withholding, elective deferrals, and deferred comp. All right, so it wasn't going to include it didn't include self-employment income because that's not subject to wage withholding, which was the whole issue between LLCs and S corporations. But a bigger question was when you have businesses that when you have multiple businesses that maybe are all doing the same sort of thing and are owned by the same taxpayer or group of taxpayers, can I use the wages from one to build up my QBI deduction in another? This is very common in any practice that owns real estate. A lot of businesses are advised by their attorneys, people like myself, to own real estate in a separate LLC just to separate out your liability, and then they'll have the operating company pay rent to the LLC, and but the wages are all being paid by the operating company. So the operating company is actually maybe not generating a lot of income. You got a lot of income in the rental property because there's not much in the way of deductions. So you're getting all this rental income, which is QBI, but all of your wages are being paid by the operating company, even though they're all part of one consolidated firm. So the question was, is there a way that we're going to be able to move those wages over somehow? And the proposed regs gave us two solutions. The first is allocation. So for under 199A, and this is a general tax rule, a taxpayer can take into account for one business any W-2 wages paid by another business as long as those wages are paid to a common law employee or officer. There was a reg under now repealed Section 199, the DPAD, Domestic Production Activities Deduction, and a common law employee will include PEOs, so that answered a big question for professional employer organizations. So if you have one of these PEOs that you're using to pay your employees, so there's technically no employees of the business, they're technically employees of the PEO. They lobbied hard to get this exception, and they got it. So if you have wages paid through a PEO, you're going to be able to use that in your W-2 wage base, as well as statutory employers and agents under the code sections I've cited. Taxpayers are responsible to file their returns on a consistent basis, and you have to take your wage deduction on the K-1 in accordance with the allocation that's used for 199A. They don't let you have it. They don't let you have it different ways. All right, whatever you do for 199A, you got to do for tax reporting as well. If you have that, so like I said, in our example where you have real estate owned by one company, operating company paying most of the wages, the taxpayer can allocate the wages paid from the operating company to the QBI from the real estate company, provided they are performing services that can be attributed to the owning of the real estate. And if you're operating these firms in a sort of a consolidated business practice, that you should be fine. There was a separate notice. So this is not the notice that gave us the proposed regulations. A separate notice, 2018-64, provides three methods for calculating and allocating W-2 wages. I'm not covering that. It's very detailed. It gets into real nitty-gritty stuff on which box of the W-2 you look at. So if you have a business that you're looking to allocate wages, please go read the notice and choose one of the three methods that it describes. But I think for even more taxpayers, the second solution is going to be the one that they choose to use. So under my previous example where you had those are two separate entities, and you're trying to allocate wages between them, the proposed regs also give you the ability to just aggregate the two entities together, provided certain requirements are met, and then you can look at the wages and the basis and the income as one aggregated number. Right, that's going to be the easiest. That's what taxpayers and professionals like myself were really begging the IRS and Treasury to come out with, is the ability to do this, because otherwise there was a lot of discussion about moving employees around, which is administratively either difficult or in some cases impossible if you have licensing requirements or contracts set up through the company, and that could change on an annual basis as your income goes up and down. So we got our wish, but unfortunately the IRS didn't use any existing grouping regime. In particular, Section 469 already had grouping for passive activities. But the IRS, they did justify it that 199A served a very different purpose than 469, so they're not going to use 469. Aggregation is elective, but once you elect it, it's pretty much irrevocable. Or at least it's presumed that it will continue. You have to affirmatively show that a business is no longer eligible or should be aggregated. You have to disclose the aggregation on your return and report that on a consistent basis among all the different entities. But aggregation is elected at the owner level. So individual owners don't have to aggregate things the same. Right? They can pick and choose which businesses they aggregate on their own, which is based on their individual income levels. Some may not need to aggregate because they're below the threshold amount. They don't care about wage and basis limitations. So in order to aggregate, businesses have to meet 5 requirements. They each have to qualify as a qualified trader business, and I'm going to talk about that later. The same person or group of persons must own 50% or more of each business, and normal attribution rules do apply to this. Family members, trusts, controlled entities are all going to be attributed to as one person. You can't aggregate specified service trades or businesses. So if in my example the operating company was a law firm, you couldn't aggregate it with the LLC that owns the property. The businesses have to report on the same tax year, and they have to satisfy two of the three factors, right? Basically, they can't be unrelated businesses. All right, they either have to provide products or services usually that are either the same or customarily offered together. They have to share facilities or centralized business elements. So, if they same HR people, same legal department, accounting department, etc. Or they have to operate in coordination with or reliance upon one or more of the businesses in the aggregated group. So this is this is the main operating company that owns multiples. Let's say you own a bunch of rental properties. They're all in individual LLCs, but all of the administration is performed through one parent operating company. That's what that would satisfy C here. So if you satisfy all of these 5 requirements, then you can aggregate the businesses. Like I said, this is meant for commonly owned businesses that are operating one line of business. So the question crops up. We were begging for this for a reason, right? Is because it applied to so many of our businesses. Well, is there ever a time when, now that I've gotten it, would I ever not want to aggregate? There is sort of one key time where you wouldn't want to aggregate. So let's say you've got Ted who owns 100% of 2 businesses, which are both S corporations. First business pays wages of $400,000 and generates QBI of $1 million. Business 2 has property, so the unadjusted basis of the property is $4 million and generates QBI of $1 million, and Ted elects to aggregate. So when you put everything together, he's got QBI of $2 million, 20% of that is $400,000. He's got wages of $400,000, half of that is $200,000, and he has basis of $4 million. So again, I made these numbers work out so that the wage and basis limitation is the same. So it's $200,000 either way. Since you get the lesser of the two, his QBI deduction is limited to $200,000. Well, we're going to, same example, except now Ted elects not to aggregate. So you're going to calculate the deduction separately for the 2 businesses. So for business 1, which had $400,000 of W-2 wages, half of that is $200,000, which is the same as the QBI deduction for business 1, which had $1 million on its own, of $200,000. For business 2, there were no wages, but 2.5% of $4 million was $100,000. So even though he only gets the lesser for business 2, he still gets $100,000. You put those together, and the total QBI deduction is $300,000. So if you just go back a couple slides, that was better than the situation when he aggregated. So essentially, if you have one business that has wages and one business that has property, and the numbers are close, you're probably better off not aggregating, because otherwise, with sufficient wages, the basis tends to get overwhelmed, and the only way you're going to get to use the basis is if you don't aggregate. All right, so I've been using this. I've been putting it up UBIA. UBIA is unadjusted basis immediately after acquisition, and so the proposed regs give us a little bit more information on that. So under the statute B2B2, unadjusted basis meant basis immediately after acquisition, and there was under the statute we knew that meant we don't account for depreciation deductions, but what the proposed regs have now clarified is that you don't use bonus depreciation either. All right, because bonus depreciation was 100%, right away. Everyone's been writing off their depreciable assets right away. So is that not considered immediately after acquisition? No, it's not immediately after acquisition. So you can still use bonus depreciation. Don't worry about it affecting your basis for 199A. Qualified property, we also got a little bit more information. So just to review, qualified property has to be tangible property subject to depreciation, so not inventory, not land. It has to be held at the end of the year by the business and used at any point in the production of QBI during its depreciable period. So the proposed regs now let us know that improvements to qualified property that are already in service are treated as separate qualified property. This is what people were, sort of assuming, but it wasn't. We didn't know for sure until the proposed regs came out. In terms of the date that you use it. The depreciable period for improvements starts on the date that the improvement was placed in service. All right, you don't tack it to the property that it improved. So, in this case, in this example, where Carol acquired and placed in service a machine on March 26, 2018, when she improves it on May 27, 2020, she's going to be considered to have two pieces of qualified property: the machine that was acquired and placed in service on March 26, 2018, and the improvements that were placed in service 2 years later. All right, two separate pieces of property with two separate depreciable periods. Another question was, what do you do with basis adjustments? So under 734 or 743, partnerships were able to step up the inside basis of assets when there was some sort of event. You had a new partner buying in, or you had a partner selling their interest. For tax purposes, you could have the outside basis match the inside basis by taking a step up in the assets. Well, let's say I completely depreciated the property in my partnership. If my partner sells their interest, somebody buys in for $500,000, can I use 743 to step up the inside basis and now we get an extra $500,000 of qualified property that I get to use for my 199A calculation? The proposed regs say no, you can't do that. Then there was also a question on hot assets. So this hot assets are certain types of property that when sold, when a partnership interest is sold, the income attributable to those hot assets, so like inventory and receivables, it's treated as ordinary income as opposed to capital gain. Again, the assumption was that if anything treated as ordinary income is going to be included in QBI, even if it's part of a capital transaction, and that turns out to be the case. So if you have ordinary income from gain attributable to hot assets, that's going to be included in QBI, and by extension, this isn't actually in the regs, but you'd think 1245 recapture income is also going to be treated the same way. As to depreciable period, the general rule is that your depreciable period starts on the date the property is placed in service, and it ends on the later of 10 years or the last day of the full year in its regular depreciation period. Right? So if you've got 39-year real property, you get to the depreciable period is 39 years. If you have 5-year property, you're going to get to the depreciable period is going to extend to 10 years because you get the later of the two. So there was a question as to, well, what happens if I get property in a non-recognition transaction? Because we know there's tacking rules and substitute basis rules that apply for other tax sections. What do we do with 199? So the proposed regs gave us, it's a sensible rule. It's going to make bookkeeping harder. It's just another entry. So the idea is that when you have property received through a non-recognition transaction, you're going to have to split the basis in half potentially. If the basis of the new property is less than the relinquished property, then no problem. You just continue to use the date that the relinquished property was placed in service. If you have excess basis, though, you have to split that off, and the excess basis depreciable period begins on the date that the replacement property is placed in service. There's an exception. If you make an election under 186I-6 which is just to not apply non-recognition treatment, then you're going to start the depreciable period for the whole property as the date that replacement property is placed in service. But that also means you're not getting non-recognition treatment. So that may work for some taxpayers, maybe, but I would think for the most part your 199A deduction is not going to offset the benefit of non-recognition treatment. So for the most part, you're going to be dealing with, when you've got 1031 or other non-recognition transactions, these two, each piece of property, you're going to have two lines for its exchange basis and its excess basis, and the depreciable period for each of those. There is an anti-abuse rule. Before we're coming up on a break. There's an anti-abuse rule that applies. So the IRS was concerned that businesses, because it just has to be held on, on the last day of the tax year and used in the production of QBI. So starting December 1st, you could go on a spending spree. Businesses could just buy a lot of property, use it for 1 month, and use the entire basis of that property to increase its QBI deduction, and even more so. So then they do that, and then they could just sell it the following year. So they haven't really bought it; they've almost rented the property just for the purposes of increasing QBI, and especially when you can have transactions between sort of related or loosely related businesses to do this. So the proposed regs have an anti-abuse rule that a property is not qualified property if it's acquired within 30 days of the end of the tax year and then sold within 120 days in the following year, unless the taxpayer can affirmatively show that it wasn't trying to, didn't do this just to increase its 199A deduction. Okay, so we've got about 20 minutes left, which is pretty much right on track. There's a lot of slides here, but I'm not going to spend a ton of time on them. This was a section where the rule is what it is. It's in the proposed regs. It's not hard to. There's not much interpretation that goes along with it. It's not a computational thing where an example would really help. And I'm not just going to read a slide to you. So for a few of these, I'm just going to fly through. But I wanted you to have them on a slide because I know a lot of you use these for reference. I don't have a separate outline I'm providing, so I wanted to make sure you had a comprehensive summary of the proposed regs in the form of the slides. So another term I've been using a lot has been specified service trader business. So specified service trader business is a bad thing. You don't want to be it, because if you're a specified service trader business and you're above the threshold, meaning 315, and certainly over 415, you get 0 QBI deduction. All right? So you don't want to be a specified service trader business. And rather than come up with its own definition, 199A piggybacked off of another code section. So it incorporated the list from 1202E3A, which includes any trader business involving in the performance of services in health, law, engineering, architecture, and so on. It modified the list a little bit. It took out engineers and architects. Excuse me. I think the idea was that Section 199, which had been repealed, primarily benefited engineers and architects. So since they were losing 199, they were not going to be excluded from the QBI deduction. And it added owners, because for self-employed individuals, they are not considered employees, and again, specified service, the definition, they wanted to capture those as well, owners of partnerships. 199A also added to the 1202 list those who perform services of investing, investment management, and trading or dealing in securities. This determination is made at the business level. So if you have Pete, who's a CPA, who's also a shareholder in an architecture firm, for which he works as the in-house accountant and bookkeeper, even though Pete is performing accounting services, the firm itself is, I'm sorry, there's a typo there, is an architecture firm, so it's not an SSTB, so Pete's pass-through income is also not going to be considered to be income from a specified service trader business. All right, you look at the type of services the business is performing, not the employee of the business or owner of the business. All right, so first off, health. The regs give us a little bit more of a detailed list of what it includes, but the important thing is that you have to provide medical services directly to a patient. All right, so that means we're excluding things like health clubs and spas. Those aren't considered performing medical services, nor is companies that basically create or provide things to medical or for medical providers. So if you're manufacturing or selling pharmaceuticals or medical devices, you're in the field of health, but you're not providing medical services and you're not providing it to a patient. Right? When Bayer makes aspirin, or I should say maybe more when Pfizer develops Viagra, they're not providing that directly to a patient. It's going to a doctor who's going to prescribe it. So this doesn't. The proposed regs haven't clarified everything because we still got medical professionals who don't provide services directly to patients. So pathologists and radiologists, they're just reading reports and scans that may have been done by direct medical providers. But radiology is just another specialty in the field of medicine. If you're a doctor, becoming a radiologist isn't really a huge detour. So it seems like, according to the definition of the proposed regs, that they would be able to take the QBI deduction. But we're not sure how that's going to shake out. Also, homeopathic medicine providers, this is where it gets, very few things are black and white. There's always a gray area, and so practitioners like chiropractors and massage therapists, acupuncturists, they're still in that gray area. I'm sure for the longest time they've wanted to consider themselves as providing medical services. They want to be considered just as much of a doctor as somebody with an MD, but maybe now all of a sudden, because of 199A, they're going to stop making that argument. But ultimately the IRS gets to have the last word. As to law, again, the law is a pretty straightforward thing. The main exclusion is providers of services that don't require skills unique to law. So there was a question as to, okay, what about court reporters and couriers, people who do things exclusively for lawyers? That would seem to be in the field of law, but kind of like medicine, you need to be considered performing services in the field of law for 199A. It means providing legal services to clients. So in this case, if you're providing a service to the lawyers themselves, you're not within the scope of the definition. For accounting, same thing. Actually, for accounting, they wanted to clarify that it's broader than, there were a lot of accountants advanced arguments, and the AICPA did as well. There's some case law out there that tried to claim that, pure tax return preparation wasn't accounting, because you don't need to be a CPA. You can do it at home on TurboTax. And then there were other accountants who claimed that internal bookkeeping wasn't accounting because you weren't providing it to the public, and like payroll processing, things like that may also not have been. So the payroll and billing argument won out. That's excluded. So if you're just doing, say, medical billing, even if you're an accountant, even if you're a CPA, if all you're doing is medical billing, or if you have a separate entity that does medical billing, you are not considered to be a specified service. But otherwise, things like tax return preparation and bookkeeping, that is considered in the field of accounting. And it's not limited to services requiring license as a CPA. It doesn't matter if you're a CPA, PA, EA. Okay, the definition is based on the type of services you're providing, not on your license. Performing arts. So the proposed regs focus on what is excluded. So like a lot of these other categories, if you're performing services that don't require unique performing arts skills, so you are the theater manager, you're the equipment manager, you're not the actor on screen or on stage, you're not the musician up on the stage, you are not considered, even though you're in the field of performing arts, for purposes of 199A, you still get the deduction. Broadcasters are also exempt. So pretty much, if you work for or I guess if you're the owner of CBS, you get to take your deduction, but if you show up on any of their programs, You don't. Authors was something that I always thought was going to get lumped into one of these categories, but at least according to the proposed regs, it doesn't look like authors would be included. DJs are an interesting example because they don't produce their own music, right? If you just play other people's music, the proposed regs make it seem like you're not a performing artist. Podcasters, same thing. You're a broadcaster, right? I mean, you're the personality, but you're also the broadcaster. So which one prevails? Athletics is very similar to performing arts. If you're not the athlete themselves or the coach, you can take the deduction. And then again, broadcasters as well. If you're Tom Brady, Bill Belichick, don't get the deduction, but the NFL Network does. Financial services. Financial services, they interpreted fairly broadly. Especially once you include the investment management category, that's covering all of your investment advisor colleagues. The only thing it excludes is taking deposits or making loans. So if all you do as a business is just loan money to individuals, that's not financial services according to the proposed regs. Otherwise you are. Brokerage services, they took a narrow definition of this as well. This is at least my assumption. When they said brokerage services, they meant like stockbroker. So, and then the proposed regs clarify that yes, they mean arranging transactions with respect to securities. It excludes, very importantly, real estate agents and brokers and insurance agents as well. As for investment management, like I said, this is going to capture your investment advisor colleagues, but it excludes managing real property. So this was a concern for a lot of real estate owners, where if they weren't performing services, if they own the property but it was all on a triple net lease, it's basically like an investment. All they're doing is collecting income, and if they sold it, they would treat it as a capital gain. In some cases just because it's being held for investment. So does that mean that I'm now in a specified service trader business? The proposed regs clarify no. It specifically excludes managing real property. Consulting was the most problematic category under the statute because a lot of people can call themselves consultants. But what does that actually mean? It's kind of a nebulous term. I think a lot of people used it because they couldn't figure out a better way to describe their business. So the proposed regs try to define what consulting is, and they say it's the provision of professional advice and counsel to clients to assist them in achieving goals and solving problems, and it specifically includes lobbying. And it excludes the performance of services other than advice and counsel. That's a little helpful, but I think the most helpful thing is there's a special de minimis rule, because the biggest concern, at least from my clients, was, hey, I'm a software developer, or I'm an interior designer. Mostly what I get paid for is a commission on the products or the services that I procure for the client, or the website that I build or the program that I code. But in doing that, I do meet with the client and talk about what they want to do and advise them on what I think the best way to do it is. So does that make me a consultant? The proposed regs provide this de minimis rule, where if you have consulting services that are embedded in or they're ancillary to the sale of goods, it's not considered consulting as long as there's not a separate payment for the consulting service. So this is sort of a safe harbor. Basically, if you don't want to be called a consultant, don't charge a consulting fee. I mean, it might just be the IRS realized this is not going to be administrable. How are we supposed to know? If you claim you're a software developer and you don't have on any of your bills a separate charge for consulting, how do we know that you also consult with the client? All of your income is it looks like it's a fee for a product, or a time charge or something like that. Something that doesn't look like a consulting fee, a separate consulting fee. So, it's a de minimis rule, but in reality, it's a pretty blanket safe harbor. I think only businesses that very obviously, so a business that doesn't provide goods at all, The IRS is going to look at you if you're claiming you're not consulting. But yeah, if you provide goods and you get paid on that basis, you should be okay. All right, so I think I said the most problematic. If I said the most problematic part of the definition was consulting, I lied. This is the most problematic part, the reputational skill clause, the catch-all at the end. So in addition to all the specified categories, it also said that a specified service was any trade or business where the principal asset is a reputation or skill of one or more of its employees or owners. So how do you interpret this? Does that mean every service business? Some people thought, well, could you do a balance sheet test? Meaning, let's calculate what the value of goodwill and workforce in place is and compare that to all the other assets of the business. And if most of it is in goodwill and workforce, then I guess it's a principal asset. Or maybe not even most, maybe just more than X percentage. Another interpretation was, well, all these other specified categories seem to be professional. So are you only looking at highly skilled services? The IRS came back with none of the above. The IRS has interpreted the reputation or skill clause extremely narrowly. It only applies to income that's earned from endorsements, likeness or image rights, and appearance fees. So only those individuals who are so well known that they can get money by putting their name on something or showing up somewhere are going to be considered captured by this reputation or skill clause. This is phenomenal. This is honestly the best part of the proposed regs, is the narrow interpretation of this clause, because a lot of people were worried it was going to mean them. They didn't make moves in their business because they figured, why split up my business if at the end of the day all of the value of the business is me? Why am I trying to separate out a specified service business, let's say my consulting practice, if they're going to just say the whole thing is due to my reputation and skill? And I think the last thing we're going to be able to cover is this safe harbor. So businesses that offered a mix of specified services and either products or other services, we're concerned, at what point, how much services do I need, specified services do I need to provide before the whole thing's treated as a specified service business? And the proposed regs have created a safe harbor. So if you have gross receipts of less than $25 million, the business won't be treated as a specified service business as long as less than 10% of the gross receipts are attributable to the performance of those specified services. If gross receipts are more than $25 million, then 10% drops to 5%. Now, does this work in reverse? So if you generate if you've got 20% of your gross receipts from specified services, is the whole thing a specified service trader business? Or does that just mean you have a separate trader business within the one entity? And then that 20% is not eligible, but the remaining 80 is. So that question's still open, but at least we know if it's under 10%, you're not going to taint the whole thing. The proposed regs also developed an anti-cracking rule. So when I talked before about an individual that was looking at, and I advise clients to do this, if you've got a portion of your business that's specified service, so let's say consulting, that was a very popular one, to be safe, why don't you put it in a separate entity? And then the other entity, the non-specified service business, you can have a common parent, you can have a fee paid from one to the other. So I was not the only one who thought of this. A lot of businesses did, and the IRS nipped that in the bud. So there's an anti-cracking rule. So if you have a commonly owned set of businesses, so that means 50% or more for purposes of this rule, and 80% of the products or services of one business are provided to a specified service trader business, that business, the non-specified one, will be treated as a specified service trader business. So if it's more than 80%, and I have a couple of examples, the whole thing is a specified service business. If less than 80%, you're not off the hook. You still have to look at, well, how much is provided to the specified service business, and whatever that portion is, that is going to be considered income from a specified service trader business. So In this example, Anne, Fran, and Stan are equal partners in a law firm. Anne and Fran form an LLC which purchases a 2-story building. The LLC rents the entire building to the law firm. There's more than 50% common ownership, and more than 80% of the property is provided to the law firm. Right? It's the whole building. So all of the rental income from the LLC is treated as earned in a specified service trader business. If we switch it up, and now same thing, except the LLC rents just the first floor to the law firm, and the second floor is rented to an unrelated plumbing business. You still have 50% common ownership, right? It's 2/3 common ownership. Less than 80% of the property is provided to the law firm, but you still have to treat the 50% of the LLC income as income from a specified service trader business. And the last anti-cracking rule is it's an incidental rule. So this is the example I've got an example coming up. So again, you need 50% common ownership, but in this case you need also shared expenses. So wages, overhead, things like that. So you don't have actually property or services or goods passing back and forth. You do have shared expenses. If the non-specified service trader business earns less than 5% of the combined gross receipts of the two businesses, it will be treated as incidental to the specified service trader business. So, and this example is right out of the regs. So you have a dermatologist who provides services through a wholly owned S corporation. The dermatologist also sells skincare products to his patients through an LLC that he owns with an unrelated person B. But the same employees and office space are used for the medical services and the skincare product sales. So it's done on site at the doctor's office. The S corp earns $1 million, and the LLC has gross receipts of $50,000. So the combined gross receipts are $1,050,000. Since the gross receipts of the LLC don't exceed 5%, remember it's 5% of the combined gross receipts, which is $1,050,000, not 5% of the specified service receipts. The sale of the skincare products is going to be treated as incidental and therefore income from a specified service trader business. So with that, it is 1:15. We didn't get to all the slides, but we got to, I think, the most important ones. There's some additional anti-abuse rules, and the big outstanding question, which is the last word I'll leave you with, the biggest remaining question from a legal standpoint is, what is a trader business? The proposed regs said that the standard they're going to use is 162, which is continuous and regular, and that's going to cover most businesses, even most rentals. The one rental activity, which the case law has said is not necessarily a 162 trader business, are triple net leases. So if you have a business that is on a triple net lease, it probably will not be considered a 162 trader business. The one exception, which is provided in the regs and is very helpful, is self-rentals, meaning a rental to a commonly owned individual or corporation is a per se trader business. So going back to that example of, let's say, the law firm and the real estate LLC. Now let's just assume we're under the threshold and we don't have to worry about the law firm being in a specified service trader business. The property, since it's rented back to the law firm, is going, even if it's on a triple net lease basis, is still going to be considered a 162 trader business. So with that, thank you everyone for your time. Have a great afternoon and good luck with the QBI deduction.